When it comes to evaluating investments, not all volatility is bad. The Sortino ratio focuses only on the downside, the risk of losing money. It tells you how much return you are earning for every unit of downside risk you take. Quick disclaimer before we start. This video is for educational purposes only. Talk to your financial advisor before making any investment decisions. Let's jump in. The Sharpe ratio treats all volatility as risk, even the good kind. But investors care more about losses than sudden gains. The Sortino ratio fixes this. It only penalizes the negative swings, not the positive ones. That makes it far more relevant for cautious or long-term investors. The Sortino ratio is calculated as your portfolio's return minus the risk-free return, divided by the downside deviation. In other words, it measures how efficiently you are generating returns while minimizing losses. Here's where it gets interesting. Unlike total volatility, downside deviation looks only at the times your returns fall below a certain target, often called the minimum acceptable return, or MAR. It ignores the good times and focuses only on the losses that actually hurt your portfolio. Think of it like this. The numerator, your excess return over the risk-free rate or MAR, shows how much extra you are earning. The denominator, the downside deviation, shows how much your returns dip below the target. Divide one by the other, and you get the Sortino ratio, your return per unit of bad volatility. The MAR isn't fixed. It depends on the investor. Some use the risk-free rate, others prefer 0, or even a personal benchmark like 8%. What matters is consistency. If you're comparing to funds, make sure the same MAR is used, or the results won't be fair. Let's take an example. Suppose your portfolio returns 12%, and the risk-free rate is 4%. If your downside deviation is 6%, your Sortino ratio is 12 minus 4, divided by 6, that's 1.33. This means you are earning 1.33 units of excess return for every unit of downside risk you take. In simple terms, it's a solid result. Here's how you read it. A Sortino ratio under 1 is usually below average. A ratio between 1 and 2 is good to very good, and anything above 2 is excellent. Higher values generally mean the investment is delivering steadier returns with less downside risk. But remember, compare funds using the same MAR and time frame. Now, how's this different from the Sharpe ratio? Sharpe counts all volatility as risk, both good and bad. Sortino ignores the good volatility and punishes only the bad one. So, a fund with frequent but positive price swings can still have a strong Sortino ratio because it's rewarding your portfolio, not hurting it. The Sortino ratio is loved by investors who prioritize capital protection, especially those who want to avoid steep drawdowns. It's particularly useful for funds or strategies with asymmetric returns, like income funds, hedged portfolios, or dividend-based strategies. Of course, no metric is perfect. The Sortino ratio still depends on historical data. Past performance might not repeat. The MAR you choose can also change the results significantly. And extreme market events, the true outliers, aren't always captured unless your data sample is deep enough. Here's how to use it wisely. Don't rely on Sortino alone. Pair it with Sharpe, Alpha, or maximum drawdown metrics. Check which MAR and time frame were used for the calculation. And always prefer data over longer periods for a more reliable picture. In India, mutual fund analysts and advanced investors often use the Sortino ratio to compare funds that focus on capital safety or steady income. Equity funds often show higher Sortino ratios than debt funds during stable market phases, because their higher returns outweigh short-term dips. But in volatile periods, debt funds can actually score better since they face fewer downside losses. The Sortino ratio tells you how well your investments are performing, given the downside risk you are taking. It's a smart evolution of the Sharpe ratio, built for investors who care more about avoiding losses than chasing every gain. Thanks for watching. Check out the description for extra resources and related videos. And if you found this video helpful, Give it a thumbs up and share it with someone who's trying to make smarter investment decisions. And don't forget to subscribe to Secure My Wish, where we simplify finance, one concept at a time.